If I was going to buy physical right now, I prefer silver to gold. So, people should be buying silver at $33 rather than gold at $3,000. Silver's got a ways to go, but once it really starts to break, I don't know where the key level is. Is it 35? Is it 40? Where it is. But I think when it goes through 50 next time, it's going to go through it, like that proverbial hot knife through butter. And then I think 50 is going to become the support level for silver. I don't know how long it's going to kind of base build at around 50, low 50s. But then I think it could quickly double to 100, especially if gold keeps rising. So if gold goes to 3,200, 3,300, I think in that environment, silver could go to 100 and it would still not be expensive relative to gold. It'd still be pretty cheap.
While gold's soaring prices have captured much attention, silver stands out as a precious metal with crucial industrial applications, particularly in the energy transition, positioning it for significant growth. After an impressive streak of 8 consecutive weekly gains, during which gold repeatedly set new record highs, its rally has paused. Prices are on track to end the week down more than 3%. As of early 2025, silver prices fluctuate between $31 and $34 per ounce, reflecting a mix of market forces, including supply and demand dynamics, geopolitical tensions, and broader economic indicators. Economist Peter Schiff remains bullish on gold's long-term trajectory, but sees silver as an even more incredible value opportunity in the current precious metals bull market. With gold now trading 50% above its previous peak, silver, by contrast, is still about 40% below its all-time high. Schiff predicts that once silver breaks key resistance levels, at $35, $40 or beyond, it will surge past $50 like a hot knife through butter, setting the stage for even more significant gains. While demand for physical gold and silver has remained strong in Asia and Eastern Europe, investors in the US and Western Europe have been net sellers, including offloading their holdings in exchange-traded funds. This wave of liquidation has contributed to lower premiums on bullion-priced coins and ingots. However, as demand for physical gold and silver continues to grow, driven by industrial use and investment, shortages are expected to become more common. Peter Schiff believes that the uptrend will accelerate once retail investors begin competing with central banks for gold. He also expects this momentum to extend to silver, which central banks have avoided mainly due to storage limitations. As a result, Schiff sees silver presenting an even stronger short-term opportunity than gold, as public demand drives prices higher. We're about to explore the video, but first make sure to subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
The opportunities in gold in the bull market, gold is now up tenfold since the low in 1999, 2000, 2001. It's outperforming the S&P. They were talking about the S&P hit a new all-time record high the other day, but compared to where it was January 1st of 2021, the S&P was down about 57% if you price it in gold. So, for all the the hype in the stock market, it hasn't even beaten a bar gold, right? And so it shows you that really what we're looking at is inflation, not legitimate increase in value. But I think at some point, investors are going to look at the bull market they've been missing. In fact, all last year, investors were selling their gold, and that's carried into this year. Americans have been net sellers of gold. They've been liquidating gold ETFs. They've been selling their physical gold. I know that just from my own gold company, where we've been getting a lot of people calling us up to sell their gold. There's been net outflows out of all the gold stock ETFs over the last year and so far this year. So Americans have been completely missing from this bull market. It's mainly been led by emerging market central banks, who have been the big buyers. And they're not anywhere near done buying. They're really just getting started. They have a lot of gold to buy. So when the public starts competing with the central banks, then I think you're going to see an acceleration of the uptrend. And I think then it'll spill over into silver, because the central banks haven't been buying silver because they don't really have a place to store it. So they buy gold. But the public will buy silver. So I think silver has even more short-term potential than gold. And I think money's going to come into the mining stocks. I think Wall Street is going to take a look at stocks that are trading. I mean, the big stocks are trading at very low multiples, low double digits, 11, 12 times earnings. And that's, trailing earnings. Their actual earnings for 2025 will probably be so much higher than what analysts estimate that most of these big stocks are probably sporting PEs of like 7 or 8. Compare that to, look, Walmart, which is down 6% today, is trading at 40 times earnings. Why pay 40 times earnings for Walmart? How fast could they grow their earnings? They don't have anywhere near the earnings growth that you're going to see in these gold mining stocks that are trading for, a fraction of the valuation of a Walmart. When gold got up near 2000 in 2011, when the public was involved, when the Fed was doing QE and everybody was worried, and gold prices got up to 1900, silver got up to 50. Now gold is 50% higher than it was at that peak, and silver's 40% lower, right? So silver's got a ways to go, but once it really starts to break, I don't know where the key level is. Is it 35? Is it 40? Where it is. But I think when it goes through 50 next time, it's going to go through it, like that proverbial hot knife through butter. And then I think 50 is going to become the support level for silver. I don't know how long it's going to kind of base build at around 50, low 50s. But then I think it could quickly double to 100, especially if gold keeps rising. So if gold goes to 3,200, 3,300, I think in that environment, silver could go to 100, and it would still not be expensive relative to gold. It'd still be pretty cheap.
The strong demand for gold in the U.S. draws bullion out of other countries as traders rush to stockpile it ahead of President Donald Trump's tariffs on Canada and Mexico. According to data from the World Gold Council, over 600 tons, nearly 20 million ounces, have been transported into New York's vaults since December of last year. This surge is unusual, as that volume of gold typically wouldn't be found in New York, noted John Reed, market strategist for Asia and Europe at the World Gold Council. Peter Schiff argues that these tariffs will mainly lead to higher prices for consumers, while providing some additional revenue for the U.S. government, which desperately needs funds. However, he emphasizes that the government won't simply absorb the full cost of these tariffs. Instead, American consumers will ultimately bear the burden in various ways. Now, let's redirect our attention to a video.
But all the tariffs are going to do, in the most part, is raise the prices of everything that's subject to tariffs and raise some revenue for the U.S. government, which the U.S. government badly needs. But all of the increase in costs won't be collected by the government, because Americans will respond to the tariffs either A, by buying the tariff goods, and in which case the government collects the 25% tariff, and Americans pay 25% more, and that tariff is a tax that the government collects. Or they don't buy that product. They buy something in America instead, and the government doesn't collect anything. But if they buy something in America that in some way competed with those tariff goods, they're going to pay more money for it than it would have cost if they bought it before the tariffs, right? Because the reduction in competition enables the domestic producer to charge more. So in which case the consumer pays more, but the government doesn't collect more. Now the U.S. company, right, benefits because it got to sell its products at a higher price. So the owners of that business will benefit at the expense of the customers. Maybe the workers will benefit. Maybe they'll be able to get a higher salary, right? So that just transfers money from some people. There's winners and losers from the tariffs. But another impact of the tariffs is prices will go up for a lot of goods, but that means they'll go down for other goods, because if consumers have to spend more money for a lot of the goods that they need, they have less money left over for some of the services that they want. And so if you're a provider of those services and you want to continue to have customers, you may have to reduce your prices. And so that's bad news for a lot of service providers who are now going to get less income because their customers have less money to spend. So there are going to be, winners and losers from these tariffs, but it's not going to provide the U.S. government with a windfall that's collected from Canada, Mexico, China. The tariffs are going to be paid for by Americans. And They are going to make a lot of goods more expensive. Some goods will be less expensive. But overall, I mean, they will hurt in a sense that all taxes hurt. Right? Whenever the government taxes you, it's a negative. Now, if the government is spending money and not taxing you, that's worse, because deficits actually are a worse tax than paying a tariff or paying an income tax, because the real cost of government is what it spends. So the government is now spending about $7 trillion a year, and it's taxing us $5 trillion, right? So where does it get the other $2 trillion? Well, it creates it. It borrows it, driving up interest rates. The Fed monetizes it, driving up consumer prices. We have to pay that tax one way or another. But the tariffs will be more immediately felt by a lot of people than the inflation, which it's already painful. But the inflation in many cases, takes time to unfold, whereas the tariffs hit you like right in the face right away, right? So there's gonna be a lot of people that are gonna, if they put 25% tariffs on cars, a lot of people aren't gonna buy those cars, because if they're 25% more, a lot of people aren't gonna buy them. Now, what might they buy instead? Maybe they'll buy a used car that's already here, that's not subject to the tariff, or maybe they'll buy an American car, right? Maybe they'll buy, or a foreign car that's made in America as opposed to one that's imported. They might do that. But they may have preferred to buy the import, but now it's too expensive, so they don't buy it.
As central banks continue accumulating gold while retail investors increasingly turn to silver, the market is witnessing a growing divergence in how these metals are valued. According to the Silver Institute's World Silver Survey 2024, silver's fundamentals remain strong, driven by robust industrial demand. The report highlights that silver demand reached a new all-time high last year, largely due to surging solar industry needs, despite stagnation in some other sectors. Meanwhile, a slight decline in global mine production contributed to ongoing deficit conditions, further tightening supply and potentially supporting higher prices. With central banks accumulating gold but not silver, does this present a unique investment opportunity for retail investors? Join the conversation. Share your thoughts in the comments, give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.